Let's understand from them what the latest move in the US means for not just the Indian stock story, but more so for retail investors. Shweta, Rajani, Associate Director and Head Mutual Funds, Rathi joins us this morning along with Kranthi, Bathini, Equity Strategist, Wealth Mill Security. Kranthi, to you first, just help us put into perspective all that we saw over the weekend, the massive swings that we saw, beginning with the US Supreme Court, followed by the 10% levy that was raised to about 15%. Overall, it seems that the 15% headline number is better than the 18% that we were otherwise subjected to. Overall, from an equity standpoint, where is the story right now and where is it headed?
Kartik, good morning to you. You're absolutely correct. The kind of events that took place during the weekend in the past 48 hours, it created a lot of uncertainty. But by and large, when we compare the earlier tariff rates and the current tariff rate of 15% flat, it's going to be positive for the market. But it's also created a lot of uncertainty how the fragile the global trade situation is right now. Look at it. The earlier statement 24 hours back, the tariff was announced at 10% and subsequently it's rise to 15%. So this number seems to be very small, 10 to 15%. We normally tend to say casually, but look at 10 to 15% is 50% rise. But still, when compared with the earlier slabs of 18%, still it's low. But by and large, there is a lot of uncertainty. And last 48 hours from Friday, there are around 211,000 containers have been waiting at different ports in US, valuing around 10 to 15 billion dollars. They're just lying in the ports to just get cleared. So these are the kind of measures that are taking place at this point of time. Of course, equity markets cheered the move. It's a second setback for President Trump administration consequently. Last week, they had a fortnight back. They had the US House that has been rejected the tariff on Canada. Just like the Trump administration has to work when they're taking these kind of measures, which are creating uncertainty in the global trade, not only to US, across the global trade. By and large, the events, the Supreme Court judgment is most welcoming move for all the countries, and it's a cheering moment for all the exporters to US. But by and large, still, it's creating a lot of day by day ambiguity. The current measures also just valid for 150 days. But what happens after 150 days again? So these are the kind of situation that we are going through. Definitely, it's the mood is definitely fragile.
Right. The mood is fragile, but the money is anything but. Shweta, Rajani, how are retail investors expected to tide through these volatile times? What should be their strategy? If we talk about mutual funds, what kind of funds should they really be betting on? And beyond mutual funds, what is the kind of caution that investors, the retail investors particularly, should be wary of?
Good morning. So yes, with this news around the tariff and Supreme Court rejecting, saying that the tariffs have been illegal, newer tariffs coming in under Section 122. All this brings in some amount of uncertainty, but also this certainty that the tariffs are going to be somewhere in teens. Now it's about how the renegotiations take place. But that's one part of the story. If you look at the broader market fundamentals, the domestics are going very strong, whether you look at the overall domestic macro situation, the valuations, we are very much sitting reasonable. We've gone through a time and a price correction both. So this is making the current entry level very attractive. From an entry standpoint, earnings have, somewhere been a mixed bag, but more, I would say, in line with the expectation for a lot of sectors and these segments. So if I look at the broader picture from a retail investor standpoint, one, if you're investing in equities, it's always going to be a medium to long-term horizon. And that looks very much steady even today. So if you're entering into equities with an expectation of a double-digit return or 11 to 14% return, which is way better than the other asset classes, that story still holds true. So from a retail investor perspective, I think they should not be disturbed by this, the way this news going around, and continue with their SIPs, their lump sum investments that they were doing, because from a 2-3 year perspective, I think the story holds very much strong.
Okay.
In terms of where they should look at, I think a portfolio which would have around 50 to 55 large, the rest between mid, small would be a good allocation to go ahead with.
I was just going to ask you that question, that should one increase the allocation of small caps in their portfolios, given that these are the sectors which are likely to benefit the most from exports. But you're still saying, Shweta, that maybe 50 to 55% should be locked in large caps. So why not increase the exposure to small caps if that is where the export dividend comes from?
So, within the mid and the small cap space, if I look at how the earnings are playing out, mid caps are looking far more steady from an
Okay.
earnings expectation standpoint. Small caps, yes, in pockets, earnings are coming in double digits, steady earnings coming in. But I would say if I want to balance both a return expectation as well as the risk or the volatility that one could expect from maybe the next few months perspective, because there's still uncertainty. Yes, you could have textiles, autos, gems and jewelry, which majorly are in small cap to benefit. But you have equal and good amount of stories even in the large and the mid cap space. So that's where a 45% allocation to mid small, which should be equally split, would be a good balance to have in the portfolio, keeping the short term volatility in mind as well.
All right. Kranthi, I also want to talk to you about the fact that as stock markets continue to be volatile and with all the tensions which we are seeing, perhaps simmering to some extent, but too early to call the US-Iran talks stroke action in West Asia. But overall, given the volatile situation geopolitically as well as now with respect to equity markets, gold, the safe haven investment sort of, continues to climb. In fact, it rose about 1.2%, again breached the $5,100 per ounce mark. Silver also climbed about 3% and rose to about 87.10 per ounce, more than the 2-week high. In the same time, the dollar has fallen as traders are still taking in their stride the US Supreme Court's decision on the tariffs. So overall, how do you see the gold and the silver story panning out from here with the volatility that we are seeing in the stock markets? And should investors really look at adding more precious metals to their portfolio?
Kartik, it's a very interesting question. I come across with different people. But when the silver was at the peak of the market in the
Yeah.
recent month back, there was a lot of speculation that was going across the globe, not only in India. And those people who never called me in the last 10, 15 years also, my phone was ringing. Okay, they want to invest and ride on to the silver rally. That's what the situation is. So there was a lot of speculative activity around the bullion markets in the recent past, in the past 1 quarter. And you mentioned the silver and gold as the safe havens. Yes, of course, they are perceived as the safe havens. But if anybody bought these asset classes, both the precious metals at the peak of the cycle in the recent past, their portfolios have corrected. Look at silver, it got corrected around 50%. So these asset classes where they are perceived as a low beta and also low volatile, but they have become very highly volatile at this point of time. Of course, still they carry the tag of safe haven, but I don't think so going ahead whether the safe haven tag is relevant for these assets, because they also behaved like equity market in the medium to short term. So some part of the allocation is definitely needed, but not for the speculation in the medium to short term. But definitely one can buy on dips in a very staggered manner. There is no hurry. They're not going to run away anytime. So slowly adding the precious metal, it can be silver as gold, as a part of portfolio diversification is warranted.
Okay, Shweta, do you concur? Do you think safe haven not as safe as it used to be? And should buy on dips as a strategy be valid even for increasing the allocation towards these precious metals as part of an individual retail investor's portfolio?
So absolutely, the perception that gold, silver, or commodities are a safer haven clearly is not true when you look at the data. Because if I look at 5-year, 7-year, 10-year rolling periods, and I look at the volatility of gold or silver versus equity, actually equity tends to have 1 or 2% lesser volatility than that of gold or silver. So that's enough data suggesting that you may want to consider it as a portion of your portfolio, but it can't be something that should take you away from equity. So it cannot be that you shift away from equity to have gold or silver in the portfolio. But yes, does it substitute for debt? That, definitely. So if you've hypothetically, let's say you had an equity debt allocation of somewhere around 70 equity, 30 debt, 70 equity should remain as is. But the 30 debt that you may have kept in your portfolio from the risk management standpoint and the diversification standpoint may be split into having a 15 to 20 debt and 10 to 15 a commodity in the portfolio. So that shift would still hold true. And yeah, if it's right now, if you look at the prices, they are still a little overvalued. So if you see some valuation correction in commodities, you may want to consider this debt portion shifting into commodities.
All right, Shweta, Rajani, I'll thank you for taking out time and being here with us this morning.